Global markets aren't reserved for big funds or inside a glossy brochure. You can start investing outside your home country with small, steady steps and a plan you can actually follow. That means you build resilience against local shocks, tap growing economies, and keep your future wealth aligned with global opportunities. This video gives a practical plan you can start this week. No fluff, just rules you can apply today. You'll see what to buy, how much to invest, and when to adjust. Start by naming your goal and your time horizon. For example, you might aim to grow a retirement fund over 20 years and keep a small emergency cash reserve separate from the market. Knowing this helps you pick a comfortable risk level and avoid chasing trends. Think about how much of your equity exposure should come from abroad versus your home market. A simple guideline is to welcome some global diversification, but tailor it to your tolerance for swings. If you have a long horizon, you can take more equity risk. If you need money soon, dial it back. Decide how aggressive you want to be with your global exposure. Even 30 to 60% of your stock investments outside your home country can reduce home bias and open up new growth paths. You can start with a single core global fund and add regional funds to fill gaps later. Choose your tools carefully. A broad global stock ETF or mutual fund can serve as the backbone of your plan. Then add regional funds for Europe, Asia, or emerging markets to tilt toward areas you find promising. Build a simple core satellite plan. The core is a broad global fund. Satellites are smaller regional funds you add gradually. The goal is to keep one clear core plus 1 to 3 satellites so you stay focused and avoid clutter. Set up automatic monthly investments to practice dollar cost averaging. This approach helps you buy consistently, even when prices swing, and it takes emotion out of timing the market. If your income is irregular, you can adjust the amount occasionally while keeping a routine. Pay attention to costs and taxes. Look at expense ratios, trading costs, and each fund's tax implications. Favor low-cost index funds and ETFs, and be mindful of commissions, spreads, and how dividends are taxed in your country. Choosing a broker matters for your global access. Look for a platform with wide access to international exchanges, low commissions, fractional shares, and solid research tools. Make sure you can automate investments, track cost basis, and file taxes without headaches. Plan to rebalance at least once a year, or when a sleeve drifts by a meaningful amount. Rebalancing brings your portfolio back to its target mix and preserves your chosen risk level over time. It's usually a small adjustment, not a full overhaul. Currency risk matters too. Some investors prefer hedged funds to smooth out currency swings, while others accept unhedged exposure for potential extra returns. Weigh the extra cost of hedging against the chance of currency moves affecting your results. Practical example: you have $1,000 to invest each month. Put 60% into a core global ETF, 20% into a Europe-focused fund, 15% into Asia, and 5% into a small emerging markets sleeve. Let automatic investments handle the timing and rebalance once a year to keep the mix intact. A broker environment also matters for your experience. If you're serious about growth, choose a broker that offers good mobile access, real-time quotes, and clear fee schedules. A smoother setup means you'll actually follow through with your plan. Avoid common mistakes that erode long-term performance. Don't chase hot funds or try to time the market, and don't ignore fees or taxes. Stay focused on your plan and give your money time to grow across different countries and cycles. Recap in brief: set a goal, pick a core global investment, add regional pieces, automate, monitor costs, rebalance, and consider currency risk. These steps turn global investing from a vague dream into a repeatable routine you can actually follow. Start small, measure progress, and adjust as your life changes. If you found this helpful, share it with someone who could use it. Like, subscribe, and leave a comment with your questions.